Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, February 9th, 2018. Wanted to give a quick update on the markets, just show you what I'm watching, what I'm looking out for here today. Yesterday, I posted some potential 60-minute divergences setting up on the SPY and QQQ. That was a scenario I laid out recently after the first bounce, and it's still very much in play. Potentially. Again, we've made divergent lows. They're not confirmed yet, and you have to see a reversal. So this is really part one of that scenario. The fact that we've undercut by, it may seem like a lot relatively looking at the bigger picture, especially the daily charts. This is just a slight undercut of those lows. Um, and that's what I was looking for now. What we need to see, and this would be quite bullish, if we see a reversal particularly today into the close. This is what I'm looking for now. A lot can happen. We can dump into the close. There was a mutual fund that blew up today. A couple members of the site posted that in the trading room, a conservative fund. We had a couple of those inverse VIX ETNs blow up last week. And so I imagine there's fear out there amongst both individual investors as well as the institutional managers. There could be a fund blowing up now. But again, this is when the big money is made, and then big money can be lost too. It depends which way this goes. So I'm not telling you with the highest degree of confidence my scenario is going to play out, but this is what I'm looking for, and this is what I'm watching for. And as the evidence builds, um, then I may become more aggressive on trading this on the long side. So as I mentioned before, um, looking for this undercut of these recent lows because, as I said, from my experience, more often than not, when you have a very sharp correction in the market, it's not a one and done. You usually come back and retest those lows. Sometimes you fall a little shy, sometimes you test them exactly at that previous low, but very often you undercut the lows. That from my experience, it tends to happen more often than not. You slightly undercut it, helps clear out the stops, shake out some of the longs that tried to buy the first dip, maybe get some more shorts in there. So what I'm looking for today would be a reversal into the close. That's what I'm expecting. And if I see it materialize, especially if it starts to build momentum into the close, that will have confirmed these divergences and it will set the stage for what I believe to be is a big, sharp rally into next week and possibly quite likely beyond. Especially if we regain those daily trend lines that I talked about in the weekly trend lines. Right now, they're being violated. Maybe I'll get to that. But I can just tell you we're a little bit under there, but we're still at some pretty decent support levels. I checked a little while ago. The SPY was at the 200-day exponential moving average. That's a pretty important support level. So again, if you want to know, if you don't know what you're doing and this kind of market scares you, sit back, wait, don't do anything. If you're an active trader and you're looking for a trading op, look for a reversal today. And if you start to see a lot of buying with momentum, here's some resistance here. You can look at kind of here this consolidation period. It looked like a little bear flag type action. You can see the swift, darn it, wrong tool. You can see a swift move down right here. That would be your flagpole, little sideways action. That's what they call a bear flag consolidation pattern, and then a breakdown. Looks to be complete or nearly complete. So again, a reversal. If we get back above there, that's an area of consolidation. That would be bullish. And and then if these markets close green today, very bullish in my opinion. And personally, I'm long and I'll be even longer if that's a proper term, more long, I should say. Just joking around going into next week. But like I said, you can't rule out the possibility of a meltdown because this was a margin bubble. I just put up a chart in the trading room, and I put up the same chart on the site a while ago. Let me show that to you real quick. Here's that chart. So, I mentioned in the trading room, and again, I put this up recently. Most of you have probably seen something similar. In my opinion, the regulators are, no, just use a word, let's just say negligent. They allow these bubbles to happen. They every time we have a big correction or bear market, they come in and they start talking about banning short selling and doing all this stuff, but yet they never do anything about bullish extremes and margin. So what you're looking at, here's the NYSE margin debt. This is margin debt. So when the market's going up, bull market, people as well as institutions, they're loading up on stocks on margin. And then what happens when you have a sharp correction, when that bubble finally pops, selling begets more selling. It's a vicious cycle. And that's where the big drops in the market come from. So you had back here, there was the dot-com bubble. That's where your margin debt peaked, and you can see the market peaked right after. Here was another bubble debt margin right here, and there's the stock market. That was a big meltdown in 2008-09. So what happens? These are unwinding of leverage, and it's just, I'm not saying this is a top. In fact, you guys know I'm looking for most likely another thrust up, but I'm open to any possibilities. And the thing is, this is unprecedented. We've never seen anything like this. This is NYSE margin debt at levels never seen before in history. So again, of course, the regulators will, nothing ever becomes of that. But again, you'll hear them crying foul during the next bear market about short sellers are the reason the market's dropping all this. No, it's the unwinding of the margin bubble. Margin bubble again. Selling begets more selling. Prices drop to certain levels. Stop losses are hit. Brokers start pushing out margin calls, forcing people to liquidate positions. And obviously, there's a good deal of that's gone on here recently. So, all right, let's get away from that and look back at the charts. But just remember, bigger picture here says, what we've seen now, the drop in the last couple weeks. Again, I don't think this is the beginning of a meltdown sell-off. I think we'll kick back. I think next week will probably be a green week in the market. I wouldn't bet the farm on it, at least not yet until I see that evidence. But at some point in 2018, most likely, maybe beyond, we're going to see one heck of a bear market. And as I said before, I think it'll be a prolonged bear market. And I'm actually looking very much forward to that because you can make money on both the short side and on the long side. Bear market rallies are extremely profitable and powerful. And again, there's always something going up when other things are going down. If your stocks are falling, you can look at commodities, gold, other things like that, bonds. Okay, so back to the charts. Basically, that's it. These are the futures again, Nasdaq 100. Here's the S&P 500. Hasn't made a marginal new low yet, but doesn't need to, as I said. When you retest lows after a sharp sell-off like that, you either fall a little shy, a little down through there. Sometimes you'll hit it to the button, but that's close enough. And again, when we look at now we jumped over here to the 60-minute chart of the SPY. Those futures will show you the round the truck I'm sorry, around the clock trading, whereas a SPY is regular hours here. So you can see we still have potential bullish divergence. All we need to see is that reversal. We don't have it yet. It's one scenario that I'm on the lookout for. If we get a reversal, especially if we start to see a lot of volume coming in, impulsive buying, we need to see a bullish crossover on the PPO. In fact, let me add the MACD here. I prefer the MACD to the PPO. Sometimes I have either or on my chart. PPO, should have had that ahead of time for you guys. Price percentage oscillator, there we go. Park the MACD over here. Here's your PPO. Looks a little better. I think that's still on the screen. Let's lift it up. If not, there we go. And you can see there's still potential divergence right there. And you can see the divergence on the RSI. But this market needs to reverse soon. Otherwise, these divergences get taken out and we can see a dump into the close, and then things can get even uglier next week. And as much as we've fallen, when you try to put things into perspective, let me just pull a clean chart of QQQ. And let's get rid of all these annotations and lines. If you look at where we've gone, and this is a log scale, you take it off log scaling, it shows you even more. But there's the last 2 years. We've gone up in 2 years, 67 or so percent, and right now we've only dropped about 12%. So, there's a lot more downside before all is said and done until valuations come back to normal levels. But the problem with a bull market and a bear market is this: always, without fail, everything swings, the pendulum swings past the point of normal. In other words, you get to excesses in both valuation, bullish sentiment at the top of a bullish bull trend or bull market, just as on the other side at the end of a bear market, valuations are well below norms. Everything's dirt cheap. Nobody wants to buy it. Everybody's pessimistic. And again, now let's not get too far ahead of ourselves. This is only a 12% correction in one of the strongest bull markets in history. So, all right, there it is. I've given you my scenarios. I was showing you SPY, I believe, a second ago here. This is QQQ, still potential divergences in place as the Qs fall, and there's a nice trend line too. So if you really want to try to time your entry, you don't want to just jump the first bounce. This is taking the form of a bullish falling wedge here. So a quick pop, and if you want to know what kind of targets I'd be looking at, if we get a reversal, if there's evidence of a reversal today into the close, I would just consider a stop not too far below your entry. Of course, remember, if you take a position today, unless you're going to trade it into the close, you'll have overnight risk 2 extra days because we're heading into a weekend. So if another fund blows up or a big fund blows up or something like that, we can gap down big on Monday. And so I'm sorry, I try to streamline my analysis and give you my opinion one way or the other. And right now, like I said, things can go either way. But again, that's my preferred scenario. But we need to see that evidence of a reversal. Let's see what else. I'm going to reserve this video for members of the site, so I'll cover this. Generally, general market analysis, I'll usually release that to the public, but any trade ideas such as this one is reserved for members of the site. I like this one right now. Treasury bonds aren't a get-rich-quick instrument, but then again, that's why I used a double position size, a beta adjusted position size of 2.0 on the trade. If you don't know what I'm talking about, it's on the front page. I put a detailed case to go long IEF today. I like, here's a 60-minute chart, divergent low. There's a lot of factors that go into this trade. I made the technical case again on the front page of the site. You can check that out. But I think the selling has been a little bit overdone. I think it's safe to say that all, if not more, of what the Fed is expected to do and what they said they would do with rate hikes have now been, at least for the time being, this is what I'm talking about, not going out 10 years, 5 years. I'm talking for the foreseeable future. I believe that most, if not all, and then some of the rate hikes priced in by the Fed or expected from the Fed have been priced into the market. Now, coupled with that, we have not yet seen, despite all this selling, we haven't seen that flight to safety bid yet in treasuries. Normally, you go back at most points in time, when you see a sharp sell off in the market, you see a flight to safety in treasury bonds. Those are the go-to flight to safety instruments. Gold is what I would call secondary flight to safety instruments. But throughout history, the institutions, smart money, that's where they flock to in government bonds. And how that works is when you buy bonds, the price goes up and the yield goes down. So I'm looking for a bounce there. And like any other trade, if it stopped out, the downside's minimal. I used a pretty attractive risk reward, so nothing ventured, nothing gained. But there's one of my favorite trades right now. And especially if the market continues to sell down in the next week, then I think you'll see a pretty sharp move into treasuries if we don't recover soon. And if we do recover soon, again, I still think it's priced into the charts that at the very least this one goes up a little bit. You're going to collect some interest on it because it's a bond fund. And again, enough said on that. You can check out that post on the front page. Maybe I'll wrap it up here. I put up another post. We hit the first target on the SOX short. This one we were in right there the very day after, just a percent or so off what so far has proved to be the highs, and I believe will most likely be the all-time highs. So um, I think it's depending on your trading plan. Again, I put notes down in that post towards the bottom. If you're a longer term swing or trend trader and you're willing to ride out counter trend balances, I still think this one looks good down to at least the second, if not the third target, and possibly more depending on what happens in the coming months. But if my near term scenario for a bounce in the market plays out, then what you're probably going to see is this is a pretty decent support level in SOX, and that's why I had it as the first target. We could see a bounce. It could take us to back test the bottom of the wedge. That'd be a great shorting op, or another time if you took profits here, partial or full profits, to recycle back in, and then look for the next swing down to that next target there. But again, longer term traders, trend traders, those that work full-time job and don't have the ability to actively trade. If you shorted right here, when we entered the trade, You can either set your stop at break even, you're guaranteed to not lose anything, or you can lower your stops. I think at this point it would be prudent to lower your stops. Say maybe a little bit above that trend line. If we run up for a back test, we may pierce it intraday, but a close back above that trend line. And again, I'll keep updates on this because it's still an active trade. Um, I think that's it. I'll wrap it up here. Same weekly chart on the SPY that I've covered before. This is that trend line now. It's clearly been violated. Barring a stick save into the close, as I speak, it's 1:13 p.m. Eastern time, so we have less than just a couple hours of trading left. Well, 3 hours of trading left, a little under that. So anything is possible. And if we don't, we're going to have a weekly close below there. That's what kicked off this big sell-off when we broke that other primary trend line, and there was, quite a bit more downside after that weekly candle. So as I said, I can see if we don't recover soon, the possibility for another 8-10% more downside in the market is there. So um, although I cannot give specific investment advice, I would just say this. If you're not sure what to do, whether to be long or short right now, and you're just not comfortable with this market, stand aside. Let the dust settle, and let the chart set us up for the next objective trading opportunity. Right now, it's not an objective time to short because if all of a sudden the markets reverse and there's a short covering rally, a short squeeze, it can shoot up faster than most would expect. Likewise, if something happens over the weekend, some bad news, or for whatever reason the funds are still liquidating, remember it's all about forced liquidations right now, or at least a big part of what's going on. And I nor anybody knows when that ends. But when people are hitting sell, 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 calling their broker saying, get me out of my mutual fund, changing out of their equities in their 401k, those institutions have to meet redemptions. They don't have the option to hold on to a stock. They might love Apple, they might love Alphabet, Facebook, all these stocks, whatever they're holding, but they are required to pay out those funds. Just like URI, T plus 3, trade date plus settlement. So if I if I own a mutual fund and tell them, take out, I have 100 grand in there, take it out today out of that stock fund, they've got to meet that redemption, and they don't have cash on hand. And that's the other thing. Most mutual funds have been running at a really low rate of cash recently with this low volatility and all that. So when all the cash on hand is out, they have no choice but to sell what they have, and that's the forced liquidation, everything I talked about before, and coupled with margin calls. But like I said, I think we hold here and bounce, and if we don't, then we'll look for the next targets, and I'll do my best to identify that. But I can see some good support coming up here on the SPY at about 248.50. That's only another 2.4% lower. All right, let's wrap it up there. I'll do another update either at the end of the day today or over the weekend. This has been Randy Finney with Right Side of the Chart. I hope you enjoy it, and